Every generation has its name. There's the boomers and the X generation, or the X generation because there wasn't enough of them for Madison Avenue to want to spend any money on marketing to them. We'll just skip and go to the next generation. So we've got the millennials and the Z. And actually, it turns out that we're likely to rename one of these generations. And the new name is, you ready? The sober generation. Who'd have thunk it? My name is Don Creech.
I'm Perry Sykes. Welcome to the Investor Resources Podcast.
That's right. The sober generation is changing discretionary spending habits because we have a whole generation of people who have decided that, unlike their grandparents, the boomers, and their parents before them in the X generation, alcohol's not a cool thing anymore.
And they're not only not trying to figure out how to get it, they don't care to get it, and so they're walking away. And it's not just the young people; it's across the board, but especially on the younger end. You are correct on the amount of alcohol consumption is very different from previous generations.
Well, and it's interesting because recently on Fox Business, which I listened to in the background during the market hours, they've had a number of new distillery owners interviewed and saying, well, the new generation isn't drinking anymore. What are you going to do? And they all have some sort of creative way that they're going to expand sales and keep their profit margins up. So I wish them well, because we want profitable companies to operate because they employ people. And if you've got employees, they spend money, which keeps other people employed. So it's a virtuous cycle for employment to exist. But you end up with the state of California, which has over the last 50 years has really developed its wine growing business with a surplus of wine left over from last year.
A huge amount.
And a bumper crop this year as things now stand.
They said they had not seen this much excess wine stored since Prohibition. So this is a significant change in what's going on with consumption. And again, it's not just here; it's worldwide. This article was about California, but I read Australia is virtually out of anywhere to store any wine, and a grape harvest just came in. So they're not sure what they're going to do. They've got nowhere to store it if they make it. California is actively removing acreage of vines. They're just tearing them out. We have to reduce the supply, and the only way that we can do it without costing us money is to pay to have them removed, because then next year we don't have to support them to grow. And so they're reducing the amount of acreage available. That is an extreme measure with the winery. I mean, the vines, that's your bread and butter. That's where everything comes from. And they're like, you know what? This is down. It doesn't appear to be changing. We have to change the supply because the demand is dropping significantly. And, that can happen in any market sector. This is just one where you can see it very clearly. And there's a social component to it where the younger generation has decided that consuming alcohol is not as much fun as it used to be, and combined with wine, especially, had been very, very popular. But also there was a big boom in bourbon. Same thing. Everything's topped out. They're not selling any more bourbon, and the number of bourbons available had reached a record. And now there's also going to be a pullback there. And of course, in a sign that lets you know this is truly a global problem, they're having trouble selling beer in Germany, which they don't even know what to think about that. And but it's true.
Well, from an economic standpoint, this must be deflationary.
Correct.
Correct. Excess supply. At some point in time, they get tired of holding the stuff, and they've got to pay off their bank loans. So they're going to have to discount prices in order to sell it.
Cut it until you can move it. That's it.
So that's actually a positive as far as the economy is concerned. Unrelated to wine, but related to the disinflationary impact on our economy, is the price of oil. This last 2 weeks, price of oil is back below $60 on the global market. And on, this is Monday morning, the 20th that we recorded this, that there were a billion a billion barrels of excess oil floating in tankers around the world that are just in transit waiting for some port to open up so they can offload it.
How's that for a change? Yeah,
Yeah,
in the mood. Yeah. Oof.
not to be outflanked. Russia has figured out if they can't bring their black market oil into some port, that reported again today is they were actually doing a transfer to a permitted ship, to a permitted tanker out in the middle of the ocean
Wow.
to take their black
Right.
market oil to a permitted legal ship that can bring it into port. I mean, there is too much oil. You say, well, how can that be? It hasn't hit the gas pump yet. You're right. It hasn't hit the gas pump yet, but that
Right.
surplus can't continue and not bring prices down. And the president wants to expand federal drilling development on federal lands, adds more supply to the global marketplace. That brings prices down for all sorts of stuff, right? Including the tractors that are supporting the wine industry, because they do a lot of harvesting mechanically now that they used to do
Sure.
with temporary labor that came up from across the border. But you think of the clothes you wear, a lot of what you wear in clothing comes from an oil derivative product. Pharmaceuticals come from oil derivative products. You go on a picnic someplace, you go into a fast food restaurant, the utensils that you're eating off of and drinking out of, oil derivative products. As oil comes down, all of that stuff eventually gets cheaper, and those price cuts will eventually be passed on to the consumer. What that means is our inflation numbers are going to start coming down before too long. There's a lag between real inflation and what the government posts as its view of inflation. And the government's slow, you know that, about
Always.
virtually everything.
You bet.
That real data inflation's coming down. Prices are going to drop. That's positive for the stock market. If you're an investor, quit worrying about these short-term pullbacks, because corporate earnings are going to expand as we move into next year. Part of this is the drop in input costs. So that's labor. Labor costs are going down because of increased automation and improved productivity. It doesn't mean somebody got fired. It means that they have capacity to generate more work per hour. And that goes to the bottom line. Cost of raw materials goes down. Deregulation reduces cost of operation just to stay in business. All of those things are positive going forward. The issue for you as an investor is where to invest.
Correct. And if you take a look at the California wine industry, you need to really, that's why you need to pay attention to what's going on currently, and not sit back and say, well, wine's been great. It's been in a huge boom cycle, and it has worldwide. And that doesn't always stay consistent. And you have to pay attention to anything you're buying and say, well, it doesn't matter how good it has been. How's it doing now? That's what matters. You have to watch what's going on currently. You have to get under the hood a little bit and say, okay, so what's actually going on around here? And you look at things like the wine industry and you say, well, wow, this looks like a real systemic sea change in the amount of demand going forward, potentially for decades, into this industry. So that tells you, okay, so wine's not going to be what it was, but that also says that's a lot of money. There's a lot of discretionary income that's going to go somewhere else. Where's it going to go? You need to track that. Follow the money, follow the trend, and see where it goes. And you don't need to take a guess. You can track those dollars, see what industries are picking up, and say, okay, I think this is where that money is going, and you can follow that. But the key is, don't sit back and say, well, this has always been good. It'll always be good. We don't have to worry about it.
Nothing is forever in the stock market.
Correct.
It is going to change. And basically, we address that through a process called sector rotation. And when you think of sector rotation, there's 11 basic sectors in the S&P 500, but each of those basic sectors have subsectors. And what's important is to be able to follow and focus on those subsectors, because that's where the major difference is between being a winner and just getting by as far as market returns are concerned. We mentioned this on another podcast earlier, but a research out of Arizona State University by a finance professor discovered that since 1926, which is a pretty long time period for most of us,
right,
found that only 4% of the stocks in the S&P 500 generated the return of the S&P 500. 96% of the stuff you buy by being diversified is doing you no good, or in fact doing you harm. None of us are Warren Buffett with a big enough bank account to buy an entire company and go tell them how to fix their problem. We have
and wait for it to turn around.
Like they had to with Coca-Cola and some
you just wait, right?
So we have to figure out where the train is running, and then get on it. And unfortunately, what we know from actual studies by multiple finance professors over the last 40 decades is that you want to get on a train that's already in motion. Newton's law is that things in rest stay in rest, things in motion stay in motion. And that applies to the stock market as well. When do you enter? Well, many people have bought into the myth that you buy low and sell high. The problem is you never know how low is low.
Correct.
And so you're always waiting. After it's been down, it rallies a little bit and you're expecting it to go down further, and you wait longer, except it goes up more. Well, basically, there are processes to recognize that what is actually winning has momentum, as in Newton's law, and the odds are in your favor that that momentum continues on the higher side. You are more successful in a portfolio when you buy high and sell higher than waiting to figure out where low is. So hopefully you can enter low, because nobody knows where the bottom is until it's history. Correct. And usually it's history at a much, much cheaper price than you're looking at getting into the market. And you're saying, what's the point now? I mean, I missed the turn. Not if it's in an upward momentum stretch. The odds are there's another point of entry right ahead of you. That requires discipline, process, commitment, and time, and some software. And if you don't have that, you need help. We're an opportunity to give you that help. That's one of the reasons we do those, introduce you to the way we think about things. But what I just gave you in terms of buy high and selling higher, there's tons of books written on this concept of momentum investing. Now, the problem that academics have is they can't figure out why it works.
They know it does, but they can't mathematically say, well, here's a formula of why this works. And so they discount it. And we say, well, we don't really care. We just know that it's repeatable and definable. And it's one of the metrics that we rely on most.
Well, and what happens there is we end up with a portfolio of individual stocks that are concentrated in winners. When they become laggards, they come out of the portfolio. As we jokingly say, we married our wives for better or worse, but our stocks, we're really fickle. If they aren't working, they get fired.
Bye-bye. Yep.
You should treat your investment dollars with the same kind of care that you want to have winners in your portfolio. And when that's not working, there's somebody else out there who will work for you. And we don't know the name of that company. You have to do some work to figure out what it is. But if you end up in an industry that's in the tank, just because it's in the tank doesn't mean it's a good buy. It may stay in the tank for a long, long time. And you have wasted the utilization of your capital. You do not want to do that. You got questions on this makes sense to you, share it with your friends, family, and coworkers. If you got questions, you want to talk to us, phone numbers on the website, on the site here. Subscribe so you don't miss our next podcast. Talking to us is free. You'll learn something no matter how much time we spend with you. But give us a call. We'll be glad to chat. Thanks for being with us, and stay tuned for our next podcast.